finance accessory dwelling units and unlock opportunities. So the goal of today, guys, we're not trying to sit here and teach you the specifics of every single loan that we can utilize for ADUs. It's really opening up talking points and opportunities for you guys as agents to create more what? Conversation, more transactions, so on and so forth. So we are going to talk about some of the loans we're offering, but really it's about how do you guys look for opportunities, okay? The problem with and I won't say the problem, but with ADU financing, a lot of the ADU financing, the most common things we hear about are what? What's the most common one you guys hear about when somebody says, I want to build an ADU, I've already got a house, what would you think of?
Hardship costs, refinancing.
Refinancing, what else? Permitting.
Down payment.
HELOCs.
Lot size?
Yeah. Does a HELOC or a HELOAN benefit you guys?
Nope.
No. But does talking about it and creating opportunity in the long run, in the bigger picture, the grand scheme of things, create a possible opportunity for you? Yes. Okay. So don't look at this as, well, that loan's not going to do anything for me. You need to look at the broader picture here when we're talking about some of these things. Okay. So why ADU knowledge matters to agents. So creates conversations with homeowners who may become future sellers. Okay. Helps buyers see hidden potential in properties that they may otherwise overlook. We've all seen that, right? We're going to talk more about that. Provides another way to address affordability and multi-generational housing needs. We are seeing a lot of people combining families into one property, and ADUs seem to be the number one answer for that right now. Opens investor conversations around increasing properties' utility and income potential. We all have some investors that we're working with that are looking to grow their real estate portfolio. And as they grow their real estate portfolio, they're growing their monthly cash flow, right? So this is going to create potentially more monthly cash flow for investors. It's going to give you a fresh, relevant reason to call your database and positions you as a real estate advisor, not simply a transaction facilitator, okay? I don't know the answer to this. I'm assuming somebody in here does. How many of you know, or Coach, or Eileen, or Rhonda, how many people use their real estate agent and they never call that agent again for a future transaction?
70%.
That's probably what I was thinking, 70, 75%, okay? Do you want to do one transaction with your clients?
No.
No, you want to be their real estate advisor for life. I know it sounds cliche, we call it your lender for life, your real estate agent advisor. It sounds cliche, but the reality is we're trying to grow a business built on referrals and repeat business, okay? You will be way more successful in this business if you contact your clients regularly. You should be contacting your clients at least 2 to 3 times a year. I would love to say I do that. Honestly, I do it probably once. And shame on me, I should probably doing it 2 or 3 more times, okay? But you should be staying in touch with your contacts simply because there is more opportunity there, because they may be looking to do something, they may have clients that want to look to do something, family, friends, you name it, there's always opportunity, okay? So, you do not need to know how to do ADUs. I'm not here to teach you about ADUs, I'm how to teach you how to recognize ADU opportunity. You guys with me? Mm-hmm. Okay, so it's about ADU opportunities. So, create listings from existing homeowners. A homeowner may say, we need another bedroom. We always hear that. My parents are moving in. We always hear that. We need more income. Everybody says that. Their first thought may be selling, but an ADU gives the agent an additional solution to discuss. Now, does building an ADU help you guys out as far as a listing? No. But if you are potentially educating them on the ADU opportunities in the future, if that home becomes too small, they need to move, they get a job relocation, guess who they're going to call to list the property? You. Remember, I'm talking about the bigger picture here. This isn't a one-time transaction. We're looking at the bigger picture. So even if you don't sell today, you've positioned yourself as what? Their real estate advisor, okay? This isn't a one-time transaction. Turning equity conversations into future transactions. So this is where HELOCs, home equity loans, cash out refinances are the most common conversations we have with people. You may already have a bunch of equity sitting in your house that you can help you accomplish this. Let me connect you with our preferred lender, and we can go through and discuss all the options they have as homeowners. So we're talking about people that are currently homeowners now, or they have multiple properties as investment, but they've got tons of equity. How much equity are we sitting on as a country right now? Anybody take a guess?
More than 50%.
definitely more than 50%. The number's got a lot of zeros, I can tell you that, okay? It is a lot of zeros. So we are sitting on the most equity as a country in terms of real estate we have ever had. What are we gonna do with that equity? Let's make use of it. Whether it's buying more real estate, paying off high interest, non-tax deductible debt, building ADUs to create more cash flow, okay? Because cash flow and creating more income is what a lot of our investors are looking to do, okay? We're also gonna help buyers see properties differently. We talked about this a little bit earlier. How many times have you guys walked into a property and your clients are like, I don't think it's big enough. The backyard's too small. The backyard's too big. The kitchen's too small. We need an extra bedroom. Is your job to say, you're right, let's go to the next one? No, what's your job? Show them opportunities that they can create within that property. So in this case, it's got a nice big backyard. Have you thought about potentially adding an ADU? Have you guys ever, have any of you ever said that to a client?
Yes.
In here? Yeah, you should be talking about these kind of things. We are starting to see more ADUs built, whether it's attached, detached, a conversion of a garage, a conversion of a separate garage. We are starting to see more and more of these, just simply because people are trying to stay kind of put. I don't know, it used to be 5.5 to 6 years was the average lifespan in a home. I think that has probably increased since COVID. I don't know what that is now. 8 years? People don't want to walk away from their 2.25% interest rate and go buy another property, okay? Now, at the end of the day, it's our job as their lender to show them the numbers and how it makes sense for them. But a lot of people are still scared about walking away from that. So what they're doing is they're staying put and adding on, okay? If you're showing a property to a new client, you gotta be creative and think about some of these things, okay? Because if they get into a bigger property, what does that equate to for you? Potentially more commissions at a higher price, right? If you're a problem solver for these clients, your clients are gonna know you're looking out for their best interests. Just like when we're talking to our clients and we're talking about pulling equity, we're showing all these ways they can save money on a monthly basis. They don't know how to do those kind of things. So it's our job to present that and put that in their minds, okay? Any questions? Okay. Overcome affordability objections. So a buyer may be uncomfortable with a $5,500 housing payment, but if they were to build an ADU and generate $1,800 to $2,200 in rent from that, does their monthly expense go down on that property?
Yeah.
Absolutely, okay? This is a huge one just simply because we have to present those numbers to them, right? We have to show them what the potential rents are gonna be on something like this. And I will tell you that one of the biggest objectives that we have as lenders, and you guys hear about it because we talk to you, is when we ask what the budget is for most of our clients, I mean, we have healthy budgets for a lot of them, but some of them come back and say, we want $2,000 a month. I'm gonna be honest with you, I don't remember the last time I did a mortgage with a $2,000 payment.
Unless they put a huge.
Yeah, it's just not common anymore. Most of our payments have a high 3, 38, 39, 4, 5, 6, 7 payment, which is kind of crazy. When I got in the business, $1,500 payments were very normal. Now we're talking on average 5,000 to 6,000.
Yeah.
Yes, Eileen?
Looking at the numbers up there, that $750 purchase price, does that include the cost of an ADU?
It can. It can go either way. That is just a image. So I didn't actually change the numbers on that. It's just an image I used for the slide. So I mean, I talked about $5,500 and it says $4,450 there. So I just tried to make it look pretty for you, Eileen.
It's very pretty.
Okay, good. Okay, the numbers just aren't right. Thanks for pointing that out. Any questions on affordability?
So is there like on, so there's like what, that all-in-one loan to where you could buy land and put a manufactured home on it? With this, is there a loan product out there to where you could buy a house that has a large backyard, knowing that you're gonna build an ADU and the loan would cover that too? So it'd be like an all-in-one product?
It would be like a renovation loan, not a construction loan.
The 203K or what?
Yeah, we're gonna talk about that, yeah.
Oh, okay.
So we're gonna talk about that, but to answer your question, can you potentially buy a property with a structure on it, a house on it, or a manufactured home, and then build an ADU? The answer is yes,
At the same time.
at the same time. But it would be a renovation loan
Okay.
over a construction loan. Construction loan is literally ground up from land, buying a piece of land, okay? So we're gonna talk about that. We're also going to create investor conversations. So if you're calling your book of business, have you looked at whether your property has ADU potential? You may have an opportunity to increase the property's income. So a lot of investors are looking for ways to increase cash flow, again, like we talked about, but maybe not buying more real estate. Maybe it's just adding on to what they have. I personally know somebody who has 10 rental properties, and he has put 10 ADUs in the back of every single one of them. That's huge. He pretty much doubled his cash flow. Not quite, but pretty darn close to it. If you have the ability to do something like that, you are going to be very wealthy as a real estate investor, okay? But it takes somebody showing them how to do it, and that's where we all step in as a team, okay? At the end of the day, what does that say up there? Say it all. Say it
Call
out
your
loud.
database and start your conversation.
Say it again, guys.
Call your database and start the conversation.
Okay, if you guys, how many of you are calling your database in here right now consistently? Be honest. Rob does? Yeah, Julie? Coach?
They call me.
Isn't that nice?
We all want to be like Eileen.
You
I
guys,
should be calling them down there.
yes, you should.
My bad.
We should be calling our database every quarter, honestly. Which, does that seem like overkill?
No.
I don't think so. Because sometimes it's just to say, like, I usually do mine during the holidays or right after the holidays, because after the holidays, what has happened? They've spent a lot of money, and a lot of times they need some cash. So it's usually Happy New Year. You should absolutely be calling during the holidays no matter what. Okay, if anything, just checking in to see how things are going. You would be surprised how many times that conversation just organically flows into, I just talked to my sister, my neighbor, they want to do this, this, and this, and guess what? Now you have a hot lead that you can, I won't say hot, but a warm lead that you can now work on, okay? So are you guys gonna be contacting your databases 2 to 3 times a year? Are you guys gonna be contacting your databases
Yes.
2 to 3 times a year? Absolutely, guys, okay. So do you guys see the opportunity out there to talk about future ADUs? How do we start those conversations? Again, it's about finding the opportunity. So what if we have a client who's got existing equity in a property? What are the 3 loans that we see all the time? We see HELOCs, home equity loan, cash out refinance, okay? So HELOC, this is the #1 way to get cash and get it quickly. So HELOCs have come a long ways. We can do them the traditional way, like we do a regular loan, where we collect documentation, we send it to one of our investors, it takes 20 to 30 days, and they pay a slightly higher interest rate, and we can get them the money. Nowadays, we have, and I'm sure you guys have seen it or heard about it, now we have AI-driven HELOC programs. So we have a couple investors where a client calls me, let's say Rob that calls me and says, I've got, I'm sitting on $1 million home, I need $400,000 cash out. Perfect. I run some quick numbers, I plug in literally like 10 pieces of information. She states what her annual income is. Let's say she says $250,000, and it says, okay, based on how much equity you have in your home, what you owe, and the stated income. So again, stated is different than actual, right? Mm-hmm. Stated income, this is how much we can offer you, okay? We can go up to 90% loan to value. So we can go up to 90% of the property. The client has to have a minimum of 620 FICO, and we can go up to $750,000, okay? It's not very common to do 750. It's very common to do about 400,000 and below, okay? Theoretically, she's gonna give me, it's gonna come back and say she qualifies for 400,000. I'm gonna send her a link, and she's gonna open up her email. It's gonna walk her through how to verify her income, because what did she do in the beginning? She stated her income. So she's gonna log online, and it's gonna walk her through a few steps, and it's gonna verify who she is, and it's gonna ask her to log into her bank account. This is where things get a little tricky, because people are like, wait a second, you want me to log into my bank account? It uses a system called Plaid. Plaid is an online verification system. If you guys have ever seen it, all the banks use it. It's very secure, but all it does is it sends a text to your phone, that phone number that's on your account with your bank, to verify you are the person actually asking to verify. You log into your checking account, your savings account, any other personal accounts you have, and it does an analysis of all of your deposits and verifies your income that way, okay? So if you stated 250, it could come back and say, we verified 230,000. It could come back and say slightly more. I'm gonna be honest with you, I don't know how it does it, because most deposits for most W-2 wage earners are what? Net income. Somehow it has some kind of algorithm that calculates gross income. I don't know how it does it. I don't ask a lot of questions, but it's pretty consistent.
So for us as agents, can we link it to the business account, and that is before tax? So would it take the commissions as, like GCI as the income?
That's a great question. How many of you that have your own business, which you should, have your personal name on your business account as well? Like Rogda Real Estate, but does it also have your full name below that? So if it has your name on the account, it'll have no problem verifying the income, okay?
If it's a company's account.
Gets a little tricky at that situation. So at that point, what we can do is upload, we never upload paperwork. We can give it access to your tax returns through irs.gov, and it can verify income that way.
No, that's very different than
It's very different.
the state did.
So here's my take on that. I pretty much, if I have a self-employed borrower, I always just put W-2 wage earner. The system doesn't verify. All it does is go in and look at the deposits, and it's pretty accurate when it does it, okay?
And would it do it for the household, for both husband and wife?
Great question. The answer is yes. So we have some programs that use one borrower, but will use total household income. We have some programs that will use both borrowers. Now, let me give you an example on that. Rogda, you and your husband have two different accounts, okay? If I use the program where you're the only one going on the loan, I can't use his account to verify additional income because it doesn't have your name on it. Does that make sense? So our job as loan officers is to ask those questions. Do you guys have joint accounts? Do you have separate accounts? It's important for us to know because it kind of drives us on which program we're going to go with. So generally we can use total household income, but it depends on how they bank and how the names read on the account as account holders, okay?
So it does not really allow a lot of flexibility because it's AI driven.
Let me tell you why it doesn't offer a lot of flexibility. You see that? 5-day quick closings? Because I can get money in their bank in 5 days versus going with a traditional program that could take 20, 25, 30 days, like a traditional loan. So I have ways around that. And my personal opinion on these quick closing AI-driven HELOCs is you literally have nothing to lose to try and apply for this to begin with. Let me tell you why. It's a soft credit pull in the beginning, and there's no cost to doing the application. So there's literally no application footprint of them even applying for anything. So we apply. If it works, great. If it doesn't, we go the more traditional route. Okay? Does that make sense?
Yeah.
So my personal opinion on this, if people are looking for quick money, which some are, some aren't. I mean, is building an ADU a quick process?
No.
No. But sometimes they need money for plans. They need, sometimes there is money that's needed. So something like this would be something you probably want to plan ahead of time. The benefit to a HELOC, though, is that there's no appraisal, no title escrow fees, money in as quick as 5 days. But the benefit of a home equity line of credit is they're only paying on the money they're physically using. So if they're not going to start the project for 4 months, are they making a payment on that line of credit in the beginning? No. They're drawing a little bit at a time as the project continues till it gets to final completion. So they're only paying on what they use. If they get a $400,000 line, then they only need 20 grand in the beginning to get the ball rolling on plans. 20, 40 grand, they're only paying on 20, 40 grand.
And is the interest rate similar or the same as the traditional HELOC versus AI driven?
It really depends. I've seen people with 800 credit scores still get prime plus 2, which is prime's at 6.75. So a 2% margin would make that an 8.75 rate. It just depends. If, say for example, a borrower has no lien on the property, we can do this and still create a first lien and pull out equity through a HELOC. A lot of times if it's a first lien where there was no loan on it to begin with, the rate is a little bit cheaper. I've also seen our more
HELOC is actually, you're gonna be paying on that, where a HELOC, you don't have to use all of it.
If I do a HELOC for $400,000, what's
You're
their
paying-
payment? Their payment is based on $400,000. So when I fund that loan, I am wiring, not me, but the escrow is wiring $400,000 to their account. They are paying on that loan whether their project starts in 6 months on construction or not. Okay? We do very few HELOCs, honestly.
Yeah, I mean,
We
why
do
would
very
you?
few. Maybe the rate is slightly better.
Is it?
Fixed rate, fixed payment, they don't have to worry about adjustments. I will tell you, I have seen HELOC payments go from, and this is years ago, but I've seen HELOC payments go from $200 to $700 because the feds
Right.
raised rates. When people are getting home equity lines of credit, it's usually based on some sort of a budget, right? So when your budget goes from all of a sudden 200 or your payment from 200 to 700, that may not fit in the budget. Whereas with a HE loan, they're calculating the budget up front, and that's what the payment's gonna be, and it's not gonna change and deviate from that, okay? So there is no draw capability from a HE loan. It is an installment loan that they get, and they just pay it off. Yes?
Is there amortization for either of them, or it's fixed?
Great question. So HE loans, we can do 15, 20, 30 year. With most home equity lines, the draw period, you guys know what a draw period is? A draw period is usually how often you can borrow from that line of credit. So usually, there's different ones, but let's just say on average, the draw period is 5 years, okay? So let's say they borrow 100 grand from the beginning. It's a $400,000 line, they got $100,000. For the first 5 years, they can borrow as much as they want until they theoretically cap out. They can pay it down, they can use it. They can pay, think of it like a credit card, except collateralized against what? Your home, okay? What happens at the end of 5 years if they don't owe anything on that? For some reason they paid it off, there's no balance owing at the end of 5 years, what happens?
It goes away.
HELOC closes, no more draw.
You can apply for a new one.
You can apply for a new one. Let's say you have a $200,000 balance. Now, your draw is over, and it becomes a repayment period on a 25-year repayment on the balance that was there at the end of 5 years. So that $200,000, they pay back over 25 years. Okay? So you could refinance it. I've got somebody who bought a property and they're sitting at a 5.5% interest rate right now. Would a cash out make sense? Potentially it could. Now, is their rate gonna be higher than 5.5%? Yes. But what we look at a lot of times when we're talking to our clients is a blended rate. If I'm looking at a 2.25 and a line of credit of, let's say, 8 to 8.5, that blended rate is somewhere in the middle. Whereas if I look at a 5.5% rate and a new equity line, that blended rate could be higher than a traditional conventional cash out where we are completely redoing their current mortgage altogether and creating one loan. Rather than having an existing first and a new HELOC or HE loan, we are now just redoing the whole mortgage and pulling out the equity. Same thing as a HE loan. If we do a cash out refinance, what happens at the end of that transaction? If they pulled out 200,000, where's that 200,000 go? Right into their bank. So if they don't need that money right away, the problem is they're making payments on that 200,000 while it's just sitting in the bank. You guys with me on that?
So what's the difference then between that and
Well, this is redoing the whole first. A HELOC
Oh, okay.
is a new second. They might be
Yeah.
maintaining and keeping that original loan at 2.25.
The cash out refi is.
It's
all
just getting rid of the current loan they have and
Yeah.
redoing everything into one new loan. Okay? So, I mean, it's pretty straightforward. Use funds to build ADU, the same thing, but with one monthly mortgage payment rather than having two. Okay? So, we do very few cash out refinances right now, simply because people just don't want to get rid of that beautiful COVID rate they have. Honestly. So, okay? Now the fun stuff. Finance the improvements, renovation loans and construction loans. This is what you guys probably want to hear more about, okay? So FHA 203Ks. Are we all heard of a 203K?
Yeah.
Okay, it's a renovation loan. So this is a purchase or renovation equals one loan, as little as 3.5% down, structural additions allowed. Okay, so they can go in and make some structural changes. ADU conversion opportunities based on after improved value. Okay, so an appraiser goes out to the property, they're gonna appraise the property based on after renovation value, after renovation cost, okay? The renovation funds are held in escrow, construction starts after closing, licensed contractors required, and then the contingency, there are contingency funds to have in place just in case I mean, how many of you guys have done construction with something before?
But then FHA, so.
FHA, yeah. Things always change, right, along the way.
Yeah.
So there's some contingency money in place. So an FHA 203K is a great route for somebody who is looking to buy a property or renovate a property, build an ADU, but maybe they're going FHA for what? What are the reasons we look at FHA? the most common reasons we go FHA versus conventional.
Low down payment.
Credit score, lower down payment, maybe they've had some credit issues in the past. FHA is a great loan, you guys. It's not a terrible loan. A lot of people will look at it and be like, oh, you're going FHA, that's a bad loan. No, it's not. It just means that it's a little bit more forgiving when it comes to the borrower's credit situation or down payment.
So does that have to be like the ADU that's attached to the property?
It does not.
It can be a freestanding?
It can be a freestanding, okay? It can be a freestanding. Now, here's what I will tell you. Every investor that we go to, does FHA lend money?
No,
What do?
they
Guarantee
insure it.
it.
They insure it, they guarantee it, okay? FHA does not lend the money. We go to wholesale investors for our loans. Every wholesale investor has the ability to put their own overlays above and beyond what FHA says, okay? So I may have 5 different wholesale banks that I can go to for a 203K. Most 203Ks will allow us to go down to a 580 credit score, like a traditional FHA. There are some investors that might say, we won't do 580, we want a 640, okay? So every investor has their own overlays when it comes to a lot of renovation. So it's our job to just make sure that our client fits the mold for whichever one we're gonna do, okay?
So renovation funds held in escrow, so they don't get access to those funds until they start.
They get dispersed out as the
As the
project
build-
is, as it's being built out.
They usually get like 4 installments or so.
Yeah, I think on a FHA 203, it's 4 or 5, I think is the breakdown, yeah. And usually construction on this they're usually like 9 to 11 months. Fitz, what would you say the average construction time is on an ADU, a freestanding ADU, or even a attached, what would you say?
Manufactured 6 months, stick built 12.
Yeah. Most of them are like 11. That's why it's really important to make sure that we're getting the contractors vetted. Most of the investors want to vet the contractors. Most of them have contractors in place that you can choose to use. Doesn't mean you can't use your own contractor, they just got to go through the vetting process.
You bring up a point that's never come up, and it's important. So if it is only 5 releases, you need to make sure you let your vendor know that's providing that ADU. Because a lot of our contracts are based on milestones.
Milestones.
If they do the excavation, send a check. After they do this, blah, blah, blah. If that's limited to 5, I've got to redo my purchase agreement.
Right. And a lot of times when you're getting, so very similar, a little bit higher down payment, what would be the purpose of somebody looking at a home style renovation versus an FHA 203K? Maybe they have a 800 FICO score versus a 640, okay? Maybe they have a little bit extra money to put down versus somebody who's looking to go FHA with only 3.5, okay? So both are very similar. Which one we go with is just gonna be case by case basis. This is a conventional home style.
But
Yep.
it doesn't need to be owner occupied.
Great question. This one does not need to be owner occupied like FHA. I'm glad you pointed that out. Thank you, Eileen. Primary, secondary, and investment properties. That is one of the big keys
That's huge.
versus FHA, because what is FHA?
Owner occupied.
Owner occupied.
Primary residence.
Yep. Thank you for noticing that.
So what?
Yes,
How is this related to ADUs?
because they could do the renovation, they can come in, buy a property that is already there. Let's say they already have a 2,500 square foot property. They got that big backyard that we were talking about.
So renovate plus build an ADU.
Well, the renovation would be classified as, yeah, the renovation is building out the ADU,
Oh, okay.
okay?
That's
So-
cool, there's no minimum.
Yeah, there's no minimum. So, and then construction begins up to 9 months. So here's the thing. So remember we were talking about having a vision when you taking people into homes? I mean, we're talking about ADUs today, but theoretically this can be used for any purpose. The purpose today is to talk about pulling and doing renovations on maybe the home and building out an ADU at the same time, okay? But at the end of the day, if you walk into a property, it's got a big backyard and they're like, man, it's just dirt. To me, that's like a blank canvas. Let's talk about how we can create more cash flow by building an ADU and actually financing it through a renovation loan.
So
Okay.
now, it looks like you could do like a 5 or 3% down?
We
with
can.
the-
So 3% would be for first-time buyers. Okay, so conventional loans used to only be 5% down or more. I would say, I don't know how long it's been, 8 to 10 years. They wanted to compete more with FHA because you're not getting a construction loan on a property that is already got a structure on it. This is buying a piece of land and building a main house, an ADU, a pool, You could build everything into your construction loan from scratch with a construction loan, okay? So 620 minimum FICO, 5% down, primary, secondary investment properties, purchase transaction, eligible, conforming and high balance options, 15, 30 year, we've got ARMs. They're all DU LP eligible, so you have to get a DU or LP findings. Borrower makes interest only payments during construction. What happens at the end of construction? You guys know?
Refinance?
We basically refinance to a permanent, traditional 30-year fix, 15-year, whatever the client chooses, okay? So during construction, it's interest-only payments. Maximum 11-month construction period followed by 1-month modification. I think on our conventional that we have, I believe you can get an extension on that for 3 or 6 months, but I have to double check that. I think it's case by case.
Yeah, it can be extended.
It
I'm
can-
doing one now.
Yeah. I think it can be extended for up to 6 months. I don't think you can go beyond 1 6-month extension. I don't think. I'm not sure. To be honest with you, building from like ground up, like a house, depending on how big the project is, but really it should be done in 12 months. Did you just do an extension?
No, but I know because my client
Asked.
asked for that. We're purchasing the land
Mm-hmm.
that is gonna be subdivided and 2 homes are gonna be built on it.
With one loan?
One loan.
Interesting. Me and Fitz have something like that right now.
Yeah.
We've got a borrower that's got military that want to do the same thing, active duty, veterans. VA goes down to 580, 100% financing, guys, like a traditional VA. Loan amounts up to 4 million, that's pretty rare. I don't think I've ever done a VA loan over 2. Primary residence only, because VA is a primary property. Does it mean they can't move out of it down the road and refinance it as a VA? They can keep it and refinance it and get all the VA benefits even though they're not living in it. They just have to occupy the property at purchase.
So we could do this for our ADU,
Mm-hmm. Yep.
the Armstrongs.
Well, they already bought it, so it's a VA renovation. The problem with VA renovation is you can't do any major structural changes. You can modify and renovate, you can't do any major construction. So that would be a challenge. Same thing, DU LP eligible, no monthly mortgage payments during construction. That is a huge one, guys. Maximum of 11 months. So VA construction, we haven't done one yet, but it's available through our investor. So it's definitely an option.
So this would be like a VA buyer buying a new construction or,
Buying a piece of land and doing the same thing they would be. Build a house and then build an ADU with it and build a pool and build whatever else they want to build, all being financed into that construction loan.
okay, so they just can't do anything like after the fact, like.
Well, no, that's not true. I could do a HELOC, I could do a HE loan, I could do,
VA using this.
yeah, I can't do a VA renovation because the VA does not allow for major structural changes, at least based on what we're